My name's Ed Croft. What I'm going to explain in this video is something that can help any investor significantly improve their odds of picking winners in the stock market. It's something that gives you an instant way to evaluate the merits of any share you hear about against all others. And this can save a great deal of research time on your initial assessment of a share, which frees you up to spend more time on things that really matter. Now, there are some exceptionally good private investors out there. I know many who invest full-time and consistently beat the stock market. But as a part-time investor, if you try to do what they do, you can end up feeling like you're coming up short. It seems like you need to be on top of the news wires every day, that you need to read all the financial statements, the chairman's reports, the analyst research notes, and so on. Now, I don't know if you're anything like me, but I really struggle to find the time to do all of this. But the good news is there is a way to do almost as well as those investors with far less effort. As I'll explain, it takes understanding some very basic principles about the traits of stock market winners and changing the game you're playing. Now, let's not beat around the bush. Most part-time investors end up with average returns at best because they do the same things as everyone else. They invest in highly speculative story stocks that they hear about from others. Some do, of course, get lucky, but the market eventually comes around and takes its toll. And I know because it happened to me. Luckily, it was early enough that it ended up being a trigger to completely transform my approach and take me on a route to develop a solution to some of these problems. I discovered what I believe to be a secret of more consistent stock market returns, factor investing, and developed an algorithm based on it called the StockRanks that's helped me and 15,000 others like me do far better in the market. But before I get into all that, I want to tell you a personal story about how this all started when I nearly lost it all just before the financial crisis in 2007. I'd been a wealth manager at Goldman Sachs, but I'd left the city to become a private investor. I was living in Australia with my wife, where my youngest son had just been born, and I was sitting on a bunch of shares that had done amazingly well over a couple of years. So much so that my biggest position now had 50% of my portfolio in it. I still look back and laugh. I mean, this was a stock with some incredible biometric technology years before Apple introduced Touch and Face ID. And my other biggest holding was in another big sector of the future, solar energy. I thought they were no-brainers, but by the end of that year, both of these stocks had cratered. When I finally got out and sold everything, my portfolio had been cut in half. It was pretty crushing. Now, while that story might be extreme, if you're anything like most investors who pick stocks on their own, you probably don't have enough time to research that many of them. So you go deep and hard on the few you do. And studies of brokerage accounts show that many part-time investors own just a few stocks in the same sector, leaving themselves open to significant risk, which is crazy really, as you have these massive natural advantages as a private investor. You're small, you're agile, you can ride the coattails of the big investors. The odds are stacked in your favor, but there are some significant obstacles to success. The first is that the media environment doesn't help, because stories in the media are often placed as PR by company insiders. Much of the investment research and news out there is funded by these parties, and while it can be very valuable, the kinds of companies that do this tend to be those that need to prop up their share price. And this influences the stocks discussed on social media, tipped in the press, recommended by city analysts. We've done loads of research to show that ideas from these sources tend to be highly speculative and on average underperform. It still amazes me that the sell recommendations of city analysts tend to outperform the buys. Yet this is where most private investors get their ideas from. But the second thing is that we can be our own worst enemy. When a story gets hold of us, we struggle to let it go. For stock pickers, a real problem is confirmation bias. You pick a share and then everything you hear about it confirms your view that the only possible end result is that it's going to the moon. So you get overconfident, you overinvest. I wanted to understand what pays off and why, and find a better way of finding ideas that relied less on the media and wouldn't lead to such emotional attachment and risk of losses. So in an extensive period of research that lasted years, I devoured absolutely everything I could about stock picking. It led me through the great financial literature, research papers by academics, stock market memoirs from famous practitioners, Bibles of data-driven analysis. I came across a research paper titled The Cross-Section of Expected Stock Returns by some academics called Farmer and French, who eventually won the Nobel Prize for Economics, and I could not believe what I read, both in this paper and others like it. The essential core of the approach was that if you sorted every share in the market by some simple measure of value, say the price to earnings ratio, from cheap to expensive, and then split the sorted list into a set of equal buckets and tracked their performance over time, you saw something really extraordinary. The cheapest bucket outperformed the next cheapest bucket, which outperformed the next cheapest bucket, all the way down to the most expensive bucket, which performed worst. This, for me, was like a revelation. Stock markets seemed so volatile, so chaotic, so random. It always appeared like you needed some unique insight about a stock to beat everyone else. But here was statistical proof of an underlying order, a sequential order in the stock market where cheap stocks beat expensive stocks systematically. You didn't need any unique insight to win. You just needed to identify and own the set of highest probability stocks. But deep value investing is risky. Cheap stocks can be cheap for a reason, and value investing strategies can lag for periods of time. So I went deeper down the rabbit hole to learn all I could about the other financial traits that could predict winning and losing stocks, to find factors that could zig when the value factor zagged. And that led me to the power of momentum, an idea so counterintuitive to value investors that they foolishly throw any mention of it out the window. This is the truth that you can sort all the stocks in the market by their share price returns over the last year or so and find that the biggest recent winners continue on to beat the biggest recent losers. That this was proof that trends persist. But what squared both of these ideas was when the academics proved a third powerful factor of quality, that profitable, cash-generative, stable stocks have a tendency, systematically, to beat their opposites. Unprofitable, cash-consuming, volatile stocks. While we all love a gamble in a blue sky stock, as Warren Buffett proved, it's the steady cash generators that win out. Now, some of these ideas seem contrary to each other. How can both buying cheap, underpriced stocks work and buying stocks at higher prices work? Well, in that example, it makes sense if you think about shares that are turning around after a bad time. They can still be cheap even when they've doubled or tripled from their lows. And herein lies the trick. These factors are more powerful in combination than they are on their own. But not only that, in combination, they perform more consistently, with less periods of underperformance and with smoother returns. To me, the combination of these three factors seemed like the master key to the stock market, and it still excites me today. Surely, I thought, if you could pinpoint exactly where each share in your portfolio lived on this spectrum of relative quality, relative value, and relative momentum, then you might be able to minimize the chance that you're holding potential losers and maximize your chance of picking winners. But the more I looked, the more I realized that while factor investing had been being used by practitioners for over 100 years, all the way back to Benjamin Graham, and the science had been verifying it for over 30 years, when I searched the web, I couldn't find any products or services out there designed to help me do this. And the real issue is that you need masses of data to sort and rank the market. You need institutional quality data because the type of data on free websites is really bad, and enough computational power to calculate the metrics required. And given the expense involved, there is no way you can afford to do this on your own. But I thought just maybe, if enough others had the same problem, we could club together and pay for it collectively. This really led on to the founding of Stockopedia.com as a subscription service. We went to hunt down the best sources of institutional data we could, Refinitiv, which was then part of Thomson Reuters. They hadn't worked on a project like this that wanted to help the little guy. They were frankly surprised we weren't targeting professional wealth managers, but we built a partnership so that we could use their data cost effectively. We hired software developers and built a pipeline of financial data. First, importing all the raw financial statements, pricing, estimates data, which we organized, cleaned, and stored in databases, and then built a computational layer to calculate the most accurate and timely set of financial ratios on the web, 2,000 for every stock, to measure their valuation, momentum, profitability, the likelihood they were going bust, the likelihood they're cooking the books, and so on. And then we built a final ranking layer to generate the stock ranks. Essentially, we do a similar process to what the academics do, sorting every stock in the market for a range of valuation metrics, such as the PE ratio and the yield, assigning a percentage ranking to each, and then combining them into a measure of value where 0 is most expensive and 100 cheapest, which we call the value rank. We then use a similar process to create a quality rank using measures of profitability, stability, and safety, and a momentum rank using measures of both recent share price strength and earnings strength. We then bring all three of these rankings together into the overall stock rank, which is an equal weighted composite ranked as a percentage between 0 worst and 100 best. These ranks are computed every day before the market opens and published on our stock reports for thousands of stocks all around the world ever since we first started publishing them back in 2013. They are just a search away. Now, within just 1 year, we found that the highest ranked buckets of stocks were doing exactly what had been proven in all the academic papers. They were beating the market and creating a performance differential to the low ranking shares. As time went on, we've seen this persist. The top ranking set have returned 16.5% annualized before dividends, while the lowest ranking set have returned -7% annualized. Of course, there's absolutely no guarantee that future performance will be like the past, but we've found similar results across most sectors and in many regions around the world. But it's not just the returns which have been promising. The higher ranked shares have shown a far higher hit rate of being winners. Since 2013, 62% of shares ranked 90 plus have been winners if held for 12 months, whereas at the other end of the spectrum, among shares ranked 0 to 10, only 35% of shares have been winners. So these stock ranks have been a way to improve your batting average. It's not that a 99 ranked stock is going to go up. There's no guarantee at all. It's just really helpful to know it's in a set of shares that have had an almost 2 to 1 chance of being a winner. And if it's ranked 0 to 10, well, you know the odds have been almost 2 to 1 against. So this is one of the great ways to use them. Imagine you hear about a share tip from another source, but you aren't sure at all about its fundamentals, and you wish you had a way to evaluate it against all the other stocks in the market. Well, that's what the stock ranks provide. In a quick search, you get an instant fix on the stock relative to every other in the market. You can instantly see whether it's good quality, reasonable value, and gaining momentum with other investors. You can check the odds. You can extend this principle to your entire portfolio. If you only own one share, then who knows what will happen. But the more shares you own, the more likely it is your portfolio return will end up like the returns of the factor exposures. Imagine being able to have confidence that the majority of your picks are amongst the top 20% highest quality, value, and momentum stocks in the market, that your portfolio is aligned with the factors that have driven stock returns over the last 100 years. Well, that's the clarity and the confidence that the stock ranks can bring to your mindset. I like to think of the stock ranks as my own sort of unfair advantage, because instead of waiting to hear other people's ideas and all the issues that come with that, I can go straight to the ready-made screens on the site and find the highest ranked shares at any time. But I'll tell you the truth, we've found that portfolios of the highest ranked shares have tended to beat our own picks. I invented the algorithm, but I still can't beat it. This year I'm up 23%, but the 90 plus stock ranks are up 32%. I broke my own rules. I hated some of the stocks on the list this year, so I tried to beat it by researching them and choosing from the list. I've ended up underperforming my own winning system. And this is really interesting and exactly why factor investing continues to work. It's why strategies based on these ideas have endured for 100 years. The truth is, we're behaviorally disinclined to buy shares that rank highly because good quality shares can be boring, cheap value shares have real current problems, and strong momentum shares are trading at high prices. It can be really hard to select these kinds of stocks, which ironically keeps their prices low and potential for outperformance high. And the reason I'm telling you this today is that as an individual investor, the odds are stacked in your favor. You already have an advantage versus all the institutional investors out there, but you've got to have an edge, which I believe the principles of factor investing provide. I've heard time and again in conversations with subscribers that access to the StockRanks can help transform your investing approach. Many talk about how much more disciplined and confident their investing is, just knowing what pays off and why. So I encourage you to go and search for your stocks and check their ranks. Not only will you see a clear measure of their quality, value and momentum against every other in the market, but you'll start understanding whether your portfolio as a whole is benefiting from these factor investing tailwinds or not. And if it's not, there's everything you need to go and find other shares to fit in with your strategy, and a brilliant community of investors and editorial staff waiting to help you. So I hope that you found some value from this talk and that it encourages you to learn more about these ideas, and I wish you luck in your own investing journey. Thanks.